Hello and welcome back to Building Wealth on the Go, a podcast by KLT Wealth Management. Today is April 16th, 2024, and we are back with Season 5, Episode 4 of our podcast. I'm your host, Brad Wilson, joined by my colleagues, Courtney Beach and Joe Filiameni. Today, back, the sun is shining. I think we've left winter behind us now, knock on wood, because just in case there does snow this week, nobody come for me. But we're back, and it's kind of that exciting time of year as the weather's getting warmer. We're looking forward to a lot of the summer activities to come. So what better way to kick that off with the exciting topic of life insurance today, right? Like that's a good way to get everybody in the mood for the summer season, all the excitement surrounding life insurance. But I think as we dive in today, Courtney and Joe, the listeners will get a sense of, there's so much out there when it comes to life insurance. It can be used for a variety of different avenues, different methods of getting it. And it is a really, really important part when it comes to your complete financial picture. Courtney, do you want to dive into maybe just a little bit high level of what are sort of the main types of life insurances that out there that somebody can acquire?
Okay. Yeah, so the main types of life insurance are your term insurance, your whole life insurance, and your universal life insurance. So your term insurance is your cheapest, generally speaking. You buy it for a set period, hence term insurance. It's usually for somebody who just needs insurance for maybe while they're working or for a certain set period of time, and then they don't really need it or feel they need it beyond that. Then you got whole life insurance, which you can keep for your whole life. It's a little bit more expensive, but then you got coverage until the end. And then you got universal life insurance that has more of an investment component to it. And it's a little more uncovered. You can see what's underneath the hood of the insurance. Whereas the others two, you're just buying the coverage. That's all you really see.
Yeah, so let's kind of pick apart each of those a little bit more and dive into. So I think term insurance, when you look at it, I link it a lot to sort of car insurance, home insurance. It's that sort of necessary evil that you've got to use and you hope you never use it. But it's one of those things you need to tack on there just to ensure that everything is safeguarded and kept well, right? And that's where it becomes very cost efficient with the prices these days.
And a lot of people get introduced to term insurance because they have a mortgage to cover. A lot of mortgage insurance is like a term type insurance. It's only set for, when you have the mortgage, you want to make sure it's paid off. So if something were to happen to you, your spouse can still live in the house. So a lot of people are introduced to it at that time.
And I think term insurance has come a long way as well. Like your term could be 10 years, 15, 20, 25 years. So you can get sort of long-term term insurance, essentially, depending upon what the need is and how long is the need for. So typically, this type of insurance would be directed to sort of your younger group, younger families, with debts and obligations or dependents. I think that's a key component that fits quite nicely. And because of its relatively inexpensive cost, it fits the budget at that stage of their life.
And I think one important thing to note is you talk about insurance coming a long way, Joe. Term insurance is kind of your foot in the door to life insurance because you don't know what your health is going to be down the road when you may be open to getting permanent insurance when you can afford it. But if you don't qualify, then it's not going to be beneficial to you. Whereas term insurance in many cases often gets you in the door, gets you in guaranteed insurability and the potential to convert that or maintain that insurance even beyond its expiry at its term. So I think that's where even getting a small amount is very, very beneficial early on because you guarantee that you will be able to be insured for life at that point.
Yeah, it is good to note that the younger you are, it's not only cheaper, like you were saying, Brad, but there's less qualifications. Like you probably won't need to get a blood test. You probably won't need to get as much done to get qualified as whereas you're older, you might have more conditions and they might want to do more testing for you to qualify.
And I think along those lines, we should sort of make a point that there is like guaranteed insurability insurance, which means when they place the policy, before they place the policy, they're doing sort of that lab work, medical questions, doctor's note and everything. So the insurance company is guaranteeing the insurability at the time of placing the policy. And the opposite of that is where they will provide you with life insurance. You're paying the premium, but they underwrite your eligibility at the time of claim, which almost kind of seems a little odd. But you think that you're covered, but sometimes you're not, because at time of claim, they would go back to the time of application and determine at that time, were you actually insurable? Did you have an underlying health issue which would have made you uninsurable? In which case, then they just refund you your premiums. So not exactly what you would want, or certainly your estate would want. So it's very important to sort of note the two differences. And there's a lot of marketing around those types of policies as well.
And I think that's important to note. Often you see that when you're getting your mortgage, that's the extra insurance option that you can add on at that point in time. And what we see a lot of times is it's not a bad option if you don't have life insurance as you're getting the mortgage. You can sign on to that and you have a little bit of flexibility of time bridging yourself to getting a standalone policy, because the important thing to know with that is often it just covers your payments or the mortgage, and as the value of your mortgage goes down, so does the insurance cost, or the insurance coverage, I should say. So that's something important to know. Whereas if you get a standalone policy, you've locked into that contract and you've gotten that guaranteed insurability, like Joe.
And since we're talking about mortgage insurance, you also have to know that if you have your own standalone policy, you take it with you wherever you go. Whereas if you change your mortgage comes up for renewal, then you're going to change your insurance too. Like, it doesn't go with you as you move, as you get a new mortgage with a new company. Doesn't.
Yeah, no, exactly.
Maybe we should contrast a little bit with the two types of permanent insurance that we discussed, the whole life and the UL. So those are considered permanent insurance, and that they will pay out upon passing. It's permanent, and that it goes to death. But that doesn't mean that you can't cancel them, in between. So the whole life insurance, typically, the standard there is the insurance company had an underlying type of investment or dividend that it pays in the policy. And so you'll see your death benefit increase typically. So it's not only that you're starting with so much coverage, but it will grow to life, obviously to life expectancy a little higher. And so those ones are fewer and fewer found out there, but they're still available, those types of policies. And then the UL policy, similar idea, but as Courtney mentioned, there's an actual underlying investment. And in a lot of cases, you get to pick the investment. So it's no different than picking your investments in your portfolio. So then it could go up, it could go down. There's always sort of a base amount that you're going to get, but the idea is, can I get a little bit more based on that investment aspect? Now, in the whole life in UL, we should sort of mention that there is a cash value within the policy, which can be accessed when you're actually alive. So if certain circumstances were such that you needed to access some cash, you can either cash out the policy and receive the cash value, or you can borrow against the policy. So you'd go to a bank, borrow against the policy, and receive that cash in order to help you with your cash flow.
And usually it's deemed as a last resort. You usually try other means of getting cash before going to the life insurance policy, but it is there.
I think it's important to sort of universal and whole life, very, very similar in nature. Whole life tends to be a little bit more expensive on the premium side of things. They do lock in that sort of dividend. Now that dividend, it can change, the company can change it, but you're relying on that one investment stream. That's the dividend that they are paying for that whole life policy. You have a guaranteed death benefit. All that is locked in. Whereas there's a bit more flexibility with the universal life policy. Often the coverage is a little bit cheaper, and you can somewhat overfund into the cash account in that nature and have it offset. You can do that in the whole life policy. It's not as common, but you can as well. So there's a little bit more flexibility on the payments and the underlying investments. So you have a bit more reliance on the investment choices within the policy for universal life, whereas with the whole life, you're looking at the company that you are signing on with for that insurance policy to help you grow that policy long term. So those are sort of the main differences when we talk about that. So let's dive into a little bit about what the process looks like. Purchasing insurance, when do you go and get life insurance, and what does that application process look like? Why don't you take that away there, Courtney?
Okay, so basically, the main reason that most people get life insurance is because they have a debt. So something happens to you, there's a debt that has to be paid, and other people are burdened to pay that if you passed away. And so you get life insurance to help cover off that debt if you should pass away. The other thing is, a lot of people don't really think about this, but your greatest asset isn't your house and it isn't your car. It's your ability to earn an income. So sometimes you get life insurance in order to cover your income you would have earned if you kept on working, to help sustain the lifestyle of your family and your loved ones if you should pass away early. So those are usually the things people buy life insurance for. Another thing is also for funeral costs. So you're not burdening your family with your funeral.
Well, along those three lines, you hit the nail on the head. Essentially, those are needs, right? So once you've identified that you have needs, whether it being a debt, whether it being dependents, in which case young dependents, which kind of covers off on Courtney's idea of that lack of income to support those dependents, and of course, funeral costs. So if you take a look at those three areas, those are the needs, and that's going to help you sort of determine when you should be buying life insurance. Now, I think the key thing too to remember is you should have bought life insurance yesterday because it is cheaper yesterday, right? And so that is, I think, a key component, because as we get older, the cost of insurance, A, goes up, and B, then there's always a chance that you're not insurable, in which case then you don't have that opportunity. So even at a young age, it's something to sort of certainly consider. There is the whole question of whether to place life insurance on your children, and there's a bit of a debate on that. Sometimes you would place some coverage to provide, again, insurability down the line for them. It's not necessarily, a windfall when your children pass away, but it's more in order to help them later on in life have that insurability for themselves. So I think that those are key components of when you actually need it.
Yeah. The other reason I lost track of thought on was to skip probate. Sometimes you want a life insurance policy to skip the whole legal process so that they get the money without probate fees. Maybe they generally can get the money a bit faster than anything that runs through probate as well. Or if you want somebody to get money and you don't want everyone else to know about it, because wills are public knowledge and you just want to, gift a little something to someone.
Yeah, excellent point. And that's why it's really important to note who your beneficiaries of the life insurance would be. And you just don't want to necessarily name the estate, because if you do name the estate, those dollars will flow through to the will, and of course then be subject to probate, and maybe that's what you're trying to avoid in the first place.
Yeah, no, for sure. And so the whole application process definitely gotten a lot better over the years when we're talking about applying for insurance. Very easy digital applications that we can go through now. And then oftentimes it used to be a medical phone call. Now there's a lot of online questionnaires that you can do to bypass that. And then oftentimes, depending on the amount of coverage, they may send a nurse out to see you to do some vitals, to do some checks, and they may contact your doctors and any medical professionals you've dealt with before to go back and assess sort of previous conditions that you may have had. So a lot of that does get done by other people, so it's not a burden on you through the application process, which is really nice. So then we kind of move on to the topic of how much insurance, and we've kind of touched on it with covering debts, covering incomes, and I think this is really where it ties into sort of us as financial planners. It's a really big, important part of building your financial plan. That risk management, insurance coverages for your various needs are really, really important. And so, Joe, what's sort of the process that we go through to assess someone's needs, to build out an insurance plan for them and create that?
Yeah, very simply, we start off with what we call a needs analysis, where we'll actually break down in terms of, okay, how much debt do you have? I think that's a great starting point. Then we take a look at your income. And then if it was a family situation, we basically look and, okay, if the one spouse passed, then the other spouse, how much of that income would you think that you would need based on the number of maybe dependents that you have? And so we factor that and we determine sort of a future value of that income stream. We add that together and then tack on some funeral costs. Generally, then that gives us sort of an overall sort of number that we can possibly do some quotes on for the life insurance. And we do keep in mind, because it's like any other business on the life insurance side with the insurance company, there are bands of discounts. So certain bands that if you bought, $700,000 worth of coverage, going to $1 million probably will cost you that much depending upon your age. So we kind of look at those bands as well, those pricing bands, to ensure that you might as well take the $1 million. And let's face it, in today's dollars, $1 million is not a lot of money anymore, unfortunately. But
Not if it's supposed to last you 10 or 20 years.
yeah, exactly. So I think doing that analysis is I know for a lot of our clients is an eye opener in terms of the amount of coverage. And we do have to justify, I think that's important. We have to justify the amount of coverage to the insurance company. So it's not, if your income is low and you have very little debts, but hey, I want $10 million worth of coverage, the insurance company is going to question that. They want to ensure that, what are you actually covering and stuff. So obviously, they're out to make money and you're out to cover, obligations and stuff. So at the same time, there has to be a reasonableness with the numbers.
Mm-hmm. Oh, for sure. And you sort of touched on it there, and we can move on to sort of strategies for life insurance, because there's a lot out there. And I think maybe we can start out with sort of the various types of insurance strategies that we look at. And sort of the one that comes to mind right off the bat for sort of anyone at any real age, and especially starting out when you're getting your first life insurance policy, would be sort of a laddering strategy. We've found that to be really effective for clients with term insurance, meaning that the insurance has been very customizable these days, where you can have, a 30-year, a 20-year, a 10-year term policy, because realistically, if you've got a big debt right now, mortgage, you're ideally going to pay that down over likely the next 30 years or so. So your coverage needs in 10 years and in 20 years is going to be very different than it is now, especially if you've got kids who might be 3 or 4 years old. In 20 years, you might not be having to, they might be out on their own, they might be launched, they might be able to, they have an income. You don't need to support them with any additional income from that term policy anymore. So assessing the needs not only today, but at the different milestones in life, and building a customized insurance plan for that, one can save you a little bit of money and also gives you that accurate sort of insurance plan over the next 30 years that you don't even really have to worry about changing it down the road. So that's something that I think has worked really, really well. And I think is becoming a little bit more popular these days now, to really forecast what your needs are, not only today, but in the future.
Yeah, that layering really works well and helps get the whole package to a good price point for someone starting off, a young family and stuff. And I know sometimes we like to layer a little bit of permanent insurance in there because again, it is cheaper to buy, and there are policies, permanent insurance policies that you can just pay for typically 8 years, 10 years, maybe 15 years, and then it's fully paid up. So that's a really nice feature, is that you'll know that you're not going to be having to spend this money for the rest of your life. You're basically paying for it typically when you're earning income, and you can afford to pay for it. And that permanent insurance would last you beyond sort of when the term policies fall off.
Yeah. So there's lots of great strategies when it comes to that. I think another one that comes to mind is when we're looking at that whole life and estate planning process, really bringing the conversation around retirement planning in, and assessing what income is coming in where, what your expenses look like in retirement, and how does a permanent insurance policy really secure not only your finances today, but also preserving and securing the estate so you know what you can spend in retirement.
That is a big, big plus. Like so often, people now we're switching gears. We're sort of at the older sort of couple heading into retirement or in retirement. And the fact that, okay, some of them want to leave something, want to leave a legacy, want to pass something on, and it may be they don't even know who they're passing it on to. Like their kids might already be okay, but what about the grandkids? What about the great grandkids? It's a great life insurance is a wonderful generational tool that you can pass dollars down by generation, and to help out those generations. And it works really, really well in those cases. But to your point, Brad, it's so much nicer to know that I can spend in my retirement as much as I need to, because my life insurance is, maybe it's already paid up because I've done it over an 8-year or a 10-year period, or like I've got it covered as part of my budget. And so having that in place, if it's important to you, and I think that that's really something, interesting, it's not important to everybody. And so it's really, really your choice. So if it's something that's important to you, you can add that strategy.
The other one is equalization, where you have a business or you have a family asset like a cottage. It's going to go to one kid, but you want to make sure the other kid gets an equal amount. So you buy a life insurance policy for the second child so they get at least a somewhat equal amount when you should pass away.
Yeah, that's a fabulous point, because we see that around here with a lot of the farming operations and the business things. Some kids are going to get the farms, they're getting the assets, and we're talking millions of dollars these farms are worth. And so then how do you equalize to the rest of the family members and stuff? Or how do you help that person who's buying that farm by, the insurance would add that cash injection, which would allow that person buying the farm to help pay and equalize to the remaining siblings. So great strategy.
The one great thing about life insurance is it has become very customizable. There are strategies out there for so many different situations. And the biggest thing is just having that conversation with a insurance representative, your financial planner, to discuss those options and see how can they tailor a solution to you, because there definitely is one out there that will suit your needs not only today but in the future. And it can be a bit of a morbid topic to talk about what's happening when I'm dying, but it becomes a really important one. And I think there's a lot of people out there that don't realize, one, what the cost can be associated, that they might be a lot cheaper than they're anticipating, and also what the benefits are beyond just a death benefit in a lot of cases as well. So I think it's really important to ask those questions, to learn a little bit about the different types, and really pursue sort of having that conversation with whomever your planner might be. So with that, we'll kind of wrap that up, because we probably could talk about life insurance for a few hours. And we may come back and circle back to it at some other point down the road. But before we close out today's podcast, let's do just a little bit of a a little bit of a high level overview of sort of the markets of late. Lots of fluctuations, volatility, something we haven't really, not surprising to us at least per se, but it's interesting heading into second half of April here and into May. What are sort of your thoughts, Courtney, on where we're at today, what we've kind of seen the last week or so, and where we're heading into May?
Well, I think the market has kind of woken up a bit. It's been a little bit sleepy for the last 4 or 5 months, and people are just, kind of waking up and realizing that, it's maybe they're getting over that COVID thing. They're starting to realize that, people are starting to make trades and deals, and businesses are doing what they, normally do. Everyone's looking towards the interest rate, whether or not they're going to lower it or not. I don't think they're going to do it till the summer, maybe, but we'll have to wait and see, to be honest.
And I think the Middle East issue, which we're currently dealing with, is certainly has been shaking up the markets and adding to the volatility. So these are these types of events that do this, where people begin to relook at their investment positions when they're worried about more war that's happening. So I think that is starting to shake things loose a little bit. Maybe, I don't think we're at a point where the market's feeling that they're overpriced yet, although we do feel that, there is a degree of increased pricing there. So, but I think it's a combination of those things which is adding to the volatility that we're seeing specifically this week.
Yeah, it's been a little bit of a pullback, about a 3% pullback, 3.5, almost 4 on the off the top of some of these indexes. Certain industries falling a bit more than others. I think we might see that continue as we enter into these spring months and into the summer. Like you said, Courtney, a lot of people banking on a June interest rate cut. I think the last thing that the Bank of Canada wants to do is cut too early. So I think they'll continue to be pedaled very cautiously on that topic. And the markets seem a little bit more on edge and very susceptible to news headlines right now. I think they just, more than anything, since COVID and since the increase of digitalization of news headlines, you can even call it misinformation, disinformation, fake news, whatever you want to call it. But all of that spearheads it, right? We've seen market fluctuations from fake news. We've seen market fluctuations from sudden news changes. So I think there's a little bit more on edge, and people quick to make decisions based off of what they see in the headlines.
Yeah, that's a good way of putting it, Brad, because when the other couple of wars we've got currently going on were announced, the markets didn't really fluctuate too much, maybe a day or two, and then they calmed down right away. And we'll have to see if that will happen again this
Yeah, for sure. So wrap it up for our podcast, season 5, episode 4. Joe, what is your tip of the month?
Well, just to stay on topic here with life insurance, I think a very, very key thing when you're looking at life insurance is understand what you're buying. I think is very, very important. So often we run across individuals who have purchased a policy and they really didn't know what they were buying. Now they're stuck with this policy. What do I do with it? I think that is troublesome because it's not like an investment in that you can, you lose in your investment, you can get out, you can put the money somewhere else. Once you buy life insurance, the question is going to be like, if you discover after 5 years that, this was not exactly what you wanted and you want to do something else, you may or may not be insurable at that point in time. So you might lose out on the insurability based on your health situation. So work with your financial planner. Don't buy insurance online on your own. Talk to somebody, look at the financial plan, look at the needs analysis, and then make an informed decision.
I think that's great. And big thank you to everyone tuning in every month, listening to our podcast. Make sure to leave a rating wherever you are listening, and subscribe on whatever platform you are currently on. Thanks again, and we will see you next month.